Hey folks, Dave Nadig here, financial futurist with Vetify. I'm joined here by my friend Sam Rines from Corbu. Sam, I'm bringing you on to talk about consumers because I feel like everything I know about the consumer sector over the last 2 years, I've learned from you. But as we get started, I'm going to go ahead and put up a chart of what the consumer has really been looking like here. And it looks to me like it's almost always a story of consumer discretionary either leading the S&P or being just behind the S&P, and staples are always the worst thing to be invested in. But the last couple of years really seems to have taken a turn there. Can you talk to us a little bit about what you were seeing last year in the pandemic when we had this big staples rally that frankly was really weird and idiosyncratic? And now we're in the middle of what seems like a huge discretionary rally. Help us break this down.
Sure. So when it comes to the Staples rally, I like to start with the framework of what happened last year that was really different from history. And quite frankly, it was the price over volume accentuation by most of the Staples companies. So XLP is mostly Procter & Gamble, Coca-Cola, Pepsi. Those are the top three holdings. Mondelez, these real boring staples companies that typically grow revenues at a fairly steady but low rate, right? It's a pretty boring place to sit around. You're not going to have the type of explosive growth that you can have in something like an XLY in the discretionary sector. But businesses, particularly those with pricing power, really pushed pricing power last year and really didn't care about how much, if at all, their volumes fell.
Is that just greedflation? I mean, that gets tossed around there. Is that just companies basically raising prices because they can get away with it because everybody assumes it's just because the price of corn went up?
Well, it's sort of. It's almost a combination of greedflation and having an excuse to finally raise prices, right? These companies almost never have the opportunity to really push price. Coca-Cola and Pepsi are in constant competition between one another to see, who can sell the most pop or cola to people. So you don't necessarily always have that type of excuse. Procter & Gamble, I mean, this is toilet paper and toothpaste and things like that, right? It's difficult to push that price on consumers unless you have an excuse to. And following the invasion of Ukraine, there were a number of reasons to do so. Freight charges went up. Everybody was hearing about the cost of shipping. Everyone was hearing about and seeing the cost of gasoline go up. Everyone was seeing and hearing about the input prices, labor costs. So it was a perfect time to really begin to push those prices. And they did it, and they did it with aggressiveness. And in a lot of cases, consumers just accepted it. Right, volumes didn't fall much at all, so revenues really began to accelerate. And as you look forward, it looks like it's going to be very good for margins as you get some underlying normalization in both supply chain, labor, and input costs.
So what's changed this year where now that same set of staples, which, I mean, if we look at earnings reports, that price over volume narrative still seems to be intact. I mean, Pepsi just reported, Kimberly-Clark just reported, and these big boring companies seem to be able to keep volumes and keep ratcheting up prices ahead of their internal costs. And yet the discretionary sector seems to be the one that's on fire. Is it the same story there? Is it just pricing power?
So no, it's not. It's actually a really interesting one, particularly with XLY, because it's 40% Tesla and Amazon, right? So it's the story of Tesla and it's the story of Amazon, right? Amazon had a horrible, call it 2021. It was just bad, right? It was coming off or 2022. It was coming off an amazing 2021 in the pandemic period where everyone sat at home and bought everything off of Amazon. And then it kind of came back down to earth, right? So it was 22 was kind of a rough year there. Now it's somewhat normalizing and it's performed somewhat well this year. Tesla, we know they don't have pricing power. They're slicing.
You're doing the opposite, right?
I mean, They are doing the opposite, and they seem to be doing it on a weekly basis at this point. So every time you turn around, you hear about another price slash at Tesla. So no, it's very much the story of that index is much more of a tech play, and tech has done a little bit better this year. And you've seen Tesla and Amazon do fairly well vis-a-vis the S&P and staples, right? So it's a much higher beta.
Yeah, let's go ahead and put up the sort of year to date here. It's worth pointing out it's hardly like this has been a barn burner for the last few months, right? I mean, it's been
Yeah.
very much in this basing pattern along with the rest of the market. It's really, I think, just holding on to those gains it had at the beginning of this time period. And I think it's reasonable to wonder whether or not that can really continue, especially when, and on your thesis, the sort of the ability to keep that pricing power up on the staple side seems to be pretty intact. So how do you think about this as an investor? Like what's the next shoe to drop there if you're worried about the consumer sector? Do you lean into the things we hear about, services, travels up 300%, overseas, all those things? It seems like the consumer is just unstoppable. Is that good for both of these sectors, or do you think we're going to have some mean reversion?
I think we're going to have some mean reversion, particularly as we go through the end of this year. It's fairly obvious that while price over volume and really pushing price is still a thing, and you've seen it this quarter across nearly every staples company that has reported thus far, that it's beginning to get a little bit of pushback, right? The McDonald's call was really interesting. They pushed a lot of price last year, very quietly. They do a very good job of doing it. But when management was talking on the conference call, he was a little tentative on how much more price the consumer would be willing to take. And I think that's really meaningful because that's not necessarily what I would describe as the higher end consumer, right? That's a consumer that tends to be in the middle of the pack. And when they begin to pull back incrementally on, I think the McDonald's CEO used the example of adding a French fry onto an order. When they begin to pull back like that, that's a sign that maybe they're beginning to become a little more price sensitive, and you're going to have a little bit more of a pushback. I would say when you kind of listen to what Pepsi's saying, when you listen to what Coca-Cola is saying, they're beginning to be a little bit more tentative about how much pricing they can push. And Kimberly-Clark on their conference call made it pretty clear that they had already pushed price this year. They had increased their prices. They didn't say the exact number, but they had increased prices in Q1, and that they may be done. There's some carryover pricing from how much they did in 2022, but it'll begin to fizzle out as we get into the back half of the year. So you are going to see some normalization on the pricing side, and maybe that'll lead to some help on the volume side. And again, that filters through the economy in a number of ways that would also be good for services and the consumer generally, in terms of that means higher freight. That means more restocking of shelves. So it's a push and pull there, where the consumer may be pushing back a little bit, and that may actually elongate the cycle of a positive consumer story.
Yeah. So let's talk about this going into the teeth of this maybe recession that we're heading into, a low but not horrible GDP print, 1.1, I think it was, right? So we're not in a recession yet, but there's obviously, that's the narrative on the street, is that we're headed into a mild recession. What's it going to be? Is it going to be a soft landing? Is it going to be protracted? If the consumer stays this strong, and if companies like a Kimberly-Clark have already managed to sort of squeeze the price elasticity as far as it's going to go, doesn't that bode pretty well for staples companies in a recession, which tend to be fairly recession-proof anyway?
It does, right? Because volumes aren't exactly going to fall much more, right? There's no real way to avoid buying toilet paper, right? Unless you have a bidet. I
remember the beginning of the pandemic, you couldn't get it at all. So the hoarding's probably over.
Exactly. So yes, exactly. They tend to be rather recession proof, if not necessarily recession proof, but recession resilient at least. And their margins will be much higher. If you go into a recession, you're likely to have things like labor costs, freight costs, input costs on the commodity front fall, and that is going to be very good for margins. So yeah, if we were to go into a recession, I think it would be somewhat of a positive for staples, particularly against the discretionary names. One note on the GDP report is that a lot of that disappointment was contained on the inventory front, which is an interesting dynamic from what we're talking about, because when you have pricing over volume and you have negative volumes coming out of these major staples, it's a sign that maybe you're beginning to see some inventory normalization. And when that inventory investment number begins to turn around, you could actually see some pretty surprising numbers on GDP on the other side of this. And when you restock, guess what? It's really good for the staples companies that are selling at higher prices. And if they also somehow manage to get a volume tailwind, it's going to be a dramatic second half of the year.
Well, so then how do we end up with a recession if the consumer stays as strong as they seem to be staying? And I've sort of heard about this hollow middle that's not participating in the downdraft, which is an interesting way of thinking about it, is that the middle class actually seems to be doing pretty darn well. That's where labor has gotten the most juice out of the market. It's sort of on the tail ends, on that sort of top 10 and bottom 10% that we've had real pullbacks, whether it's at the asset level, obviously last year in the markets, but also just in terms of their basic survivability at the lowest end of the market. How do we go into a recession if the middle class consumer is still staying strong? Is it purely just about investment and capex drawing down?
Maybe, but the problem there is that non-residential investment's still holding up really well, right? It seems like every 2 minutes you have a new factory being built somewhere in middle America, right? Whether it's Ford, whether it's GM. These are significant investments that are happening. Those are jobs that are being created, and they're high-paying jobs. Manufacturing jobs are relatively high-paying, and they tend to be very middle class, right? One of the things you're seeing in the data is that high school education or less, that category is outperforming everyone when it comes to their wage gains. So middle America is really doing well. When you look at the West Central, I believe, census district that includes a lot of the farming areas. All of those districts are under 3% unemployment right now. So middle America is really on fire. And when you listen to, and this is the important data point for me for the summer, and call it consumer health. It's not necessarily looking at what's going on with retail sales. It's what's going on with the services and travel business. And when you listen to airlines, every airline is saying bookings are through the roof, pricing is through the roof. We don't have enough capacity. And, hotels, Hilton announced a killer quarter, up their guidance for the year because they're looking at bookings that are super strong. Carnival, Norwegian, all of the cruise lines, same thing. So it's really difficult to say that there's a significant pullback by the consumer when they're still buying incredibly overpriced airline tickets like it's going out of style and going on cruises, which I don't know why anyone would go on a cruise, but they're going on cruises like they never have before and booking them at high prices, et cetera, et cetera. So it's really hard to say that we're not going to make it through the summer somehow when the consumer's pre-booking summer vacations at clips that we haven't seen in a very long time. So if you make it through the summer with, I call it the revenge of middle America, right? If you make it through this summer with the revenge of middle America and all of a sudden everything kind of seems fine, I mean, the back half of the year doesn't look that bad. All of a sudden you have a restocking cycle, you have a labor market that's still running a sub 4% unemployment rate. I mean, it's very difficult to convince me that somehow we're going to fall into a significant slowdown outside of what we hear about the coasts, right? The coasts get all the headlines. Middle America gets very, very few, and middle America is booming.
Right. And, you brought up the sort of the factory building that we're seeing. I mean, that's the whole sort of reshoring, deglobalization angle of this too, which, maybe that overcomes the rate environment and credit crunch to continue that investment, right?
Well,
that's got to be the angle.
Yeah. And they're very, very long cycle investments, right? This is not the type of investment you make and all of a sudden a 5% interest rate is crushing your hurdle, right? That's just not the way that it's really being thought about. So they're very interest rate insensitive in a way, right? GM and Ford can tap credit markets. They don't have to go to a bank. So it's a much different style of investment than simply thinking about it as a bank crunch is going to kill non-residential investment. That's just not true.
Got it. Well, this has been frankly uplifting, which I don't usually expect that of you, Sam, to be honest. I expect you to be a little more dour. So before we go, I got to ask you, what's the what's the problem that we're not looking at here? What could go wrong here, other than obviously the political shenanigans, which, I mean, that is always an existential risk for markets. But in terms of just the core of actual businesses, what do you think we should be looking out for that might change this narrative?
What I think could change the narrative, and it's actually hard for me to be dour, so I'm not sure how to say this, but I think the more tech layoffs we see, the better for S&P 500 returns moving forward. There's a lot of operating expenditures that those companies can take out. There's a lot of earnings they can drop to the bottom line. And when you get to a more competitive environment on the volume front for the staples companies, guess who spend a ton of money on advertising? Staples companies. So once you begin to have this price over volume cycle and more of an inventory replenishment cycle begin, I think the large tech companies that kind of took their medicine in a meaningful way are going to be some really interesting investments where people really haven't begun to assess just how much OpEx can be taken out and just how much profitability they can have.
Got it. So cost control is going to be key here, right? And when we start feeling like that's slipping, that's when we should probably pay attention. Seems like that's a few quarters out, though. We're going to be worrying about that. Certainly the earnings we've seen in the last week or two, cost control seems to be in force, right? Facebook, 1% reduction in sales force, even though they had like a 6% headline. That means they were massively over their skis in hiring. And I think I saw that in numerous earnings reports where it seemed like there was a little bit of fiscal discipline coming in. Would you agree?
I would agree. And that's where I'm actually somewhat positive, almost regardless of, having a kind of softish landing or having a, call it a mild recession. It's really hard to get bearish from here on asset markets. There's a lot of headwinds sitting out there. There's China headlines. There's a war going on in Europe. Oil prices remain somewhat high. There's a number of headwinds to the consumer, to equity markets, et cetera, that we've really kind of begun to look through to the other side. So there's a number of positive catalysts, and most of the negative catalysts are kind of here.
Yep. Well, gosh. Well, this has been the highlight of my week. I came into this all depressed, and you've got me all excited. So, Sam, thanks for joining us. People want to follow you. It's at Samuel Rines on Twitter, right?
It is. Yes.
Well, thanks for having us. I'm sure. And thanks for joining us. And I'm sure we're going to have you back. Cheers, Sam.
Can't wait.